future trends, deep insights, industry leaders. This is the iGaming Next podcast with your host, Pierre Lindh.
This podcast is brought to you by Pragmatic Solutions, the leading iGaming PAM platform with a modular approach, including many benefits like a fast, secure, and scalable API-based platform, integrated with all major third-party products and services. Make sure you head over to Pragmatic Solutions and join our smart thinking.
And good afternoon and good morning to you, Thomas Allen, Managing Director, Equity Research of Morgan Stanley. How are you doing today?
I'm good, Pierre. How are you?
I'm doing great, thank you. I'm doing great. As you know here, we are in the full planning mode for iGaming NEXT New York taking place here on the 12th and 13th of May. And we're really happy and excited, of course, to have you aboard here for New York. So I'm looking forward to see you in a month and a half. But as a starting point, I mean, looking forward to that event, Thomas. What are you expecting to kind of, come out of and learn from that event in general?
Yeah, look, I mean, the market's really focused on a few things right now. Primarily the U.S., right? I mean, that's the new growth market in sports betting and iGaming. I think the question around market size is still a debate, but I think that's much less of a focus right now than profitability. When are we going to get there? How is it going to come about? For at least for the operator side, and then all through the value chain, how things are going to progress has been a big focus among investors.
Absolutely, and like you're saying, the American market is hyper interesting at the moment for this specific reason, I suppose, that the American operators are growing in terms of revenue, but it's still a bit of a question mark. I guess the market is still kind of unproven in terms of what type of profitability we will be seeing. And, just to jump straight into it here, Thomas, I mean, as we just mentioned here, many of the operators have been communicating now that 2023 is the year where we will see profitability in the US market. DraftKings have been clear on this at the end of 2023, as has other operators as well. But obviously, just reaching profitability is not enough on its own. The investors are expecting to see major EBITDA margins in order to justify the large market caps that currently is in place. So can you talk a little bit about what do you think we can expect in terms of profit margins in the long run for the American markets?
Sure. And Pierre, let me clarify one thing you said. You said large market caps that have been created for these U.S. operators. I would say, given how weak the stocks have performed, they're not as large anymore, and maybe not fully representative. High expectations around margins, but let's get into it, right? So. If you look at Europe and global, online gambling and sports betting companies typically have about 25-30% margins. The companies at the higher end of that range typically have customer acquisition advantages. And obviously things like tax rates can have an influence. When we think about the U.S. market as a whole, we think it's going to be pretty comparable. We don't think that operators will really be at the high end of that range, or closer to 25%. When the market matures around 2025. Well, let's think about the gives and the takes, right? So one, in general, the U.S. market's going to have a higher tax rate than international markets. Beyond just the state-by-state tax rates, you also have a federal excise tax, which turns out to be about 3% of revenues. We're modeling about mid-20% tax rates. So that's higher than if you think about the UK blended a little bit below 20. Australia, I think blended is around 12. So that's going to be a negative thing. Payment processing is a lot more expensive in the US. Not all traditional banks accept traditional transactions in this country, so payment processing is more expensive. We're seeing data rights inflation, so that's another cost pressure there. And so all those things are headwinds. Where can there be some offsets? So, where we are most optimistic, and it sounds crazy right now, is actually around marketing efficiency. So, I brought up earlier that the most, everyone's like, how can you think this when,
yes.
when so many companies are spending so much money?
Yeah.
But the reality is that, if you think about the main operators in the U.S., one, there are only a few of them, right? So there are basically 5 operators in the U.S. market today that have over 80% market share. And 2, all of them have a customer acquisition advantage, right? You think about the legacy DFS companies, they have all these old customers. You think about the legacy casino companies, they have all these old customers that they can cross-sell efficiently and hopefully find ways to retain them in the future as well.
Right. And I guess that's what we're seeing, for example, in the example of DraftKings now, who are launching a NFT marketplace, for example. They are kind of growing horizontally rather than vertically, adding on different verticals to their portfolio. And I believe that that's a strategy that DraftKings have kind of communicated. I know that Chris Grove, one of the most knowledgeable kind of industry experts, have been talking about we shouldn't look at DraftKings as just a sports betting company, but they want to kind of use the database in order to launch more verticals. Is that something you guys think as well when it comes to DraftKings specifically? Is that the key to their success and the reason why they are spending so much money on marketing at the moment?
Yeah, I mean, yes and no, right? So I like look at my model. We have DraftKings doing about $4.5-5 billion of revenue in 2025. Only a couple of $100 to $200 million of that is other things, right? Like I think that NFTs is an opportunity. DraftKings has done well and has made strides in that so far. But if we look at these global businesses, right, like they haven't historically found a lot of other verticals to make money. And, one of the examples we're often given is like media, right? Yes. But what you have to think about is if you're a gambling company or an online gambling sports betting company and you're getting customer mind share, what is the best way to monetize that? Is it to send people towards, a soft drink? Or is it to send people towards gambling on your site where you're going to make much better economics on it? And so, I think that there are probably other things on the margin that these companies are going to be able to make money on. But I think that the majority of how they're going to earn in the future is going to be based off of that core business.
Right. Fair enough. Just jumping back to the profit margins and expected EBITDA result here as the American market matures. As an example, Flutter just released their annual report here for 2021, publishing a $1 billion EBITDA result. I can't remember the currency correctly, but in excess of $1 billion EBITDA result they published in the positives, and that is obviously for the global operations. Now, Flutter obviously has been a machine in the last 15 years, being able to optimize the processes, optimize marketing spend and so forth on a global level, being able to reach that 1 billion mark. Now, if we look at then the American market, DraftKings currently has a market cap at the time of this recording of something around 7.2 billion USD, something along those lines. And so to justify that market cap, you would expect a positive EBITDA result of around 1 billion USD in order to justify a 7 to 8 billion market cap and so on. Do you believe that the American opportunity from the sports betting and online gambling side is big enough to justify that type of market cap? Like, can DraftKings reach a 1 billion plus EBITDA result when Flutter currently achieves that on a global scale?
Yeah, so the benefits of having my computer in front of me is that
Yes.
Flutter is £1 billion, so
Billion
it was
pound. Fair
okay,
enough.
billion pounds. So
Yes.
so look, a couple of thoughts on that. We do think that DraftKings will get to $1 billion of EBITDA in 2025.
Right.
And you brought up the implication that a high single digit valuation is fair for these kinds of companies, and I disagree with it. Right, I think that a mid-teens valuation is more fair. Right, so I think
Okay.
that if you look at the broader, global online sports betting and iGaming business, it's still growing revenue top line 7-8% a year.
Yeah.
If you took out all the restrictive measures that are impacting, European markets, you should be getting good cost leverage on a fixed cost base. Like, these are technology companies at the end of the day.
Yeah.
And so that should drive double-digit EBITDA growth. And for double-digit EBITDA growth, that are mostly, have relatively low capital commitments or CapEx commitments, I
Okay.
don't think a mid-teens multiple is unfair at all. And I mean, I think that's, traditionally where you've seen internet stocks trade. And so,
Yeah.
our key point on DraftKings is that, the U.S. market is at, I don't know if we want to use a baseball analogy, are we in the third inning, fourth inning, right? Like, we're at the beginning of it, right? We're expecting revenue growth for the industry for the next 3-4 years of, I think, about 40% a year.
Okay.
And, and so high multiples should be justified in this context.
Yeah. Yeah. All right. Fair enough. Fair enough. And I mean, speaking of multiples overall, I mean, in recent months, the multiples have obviously come down significantly, particularly for growth stocks worldwide, and within the online and sports betting industry, particularly. Can you talk about why do you think the multiples have gone down, and why do you think the share prices have gone down for keeping ourselves into the DraftKings example here, which seemingly have been performing as expected, but still they have lost about 65-70% of their market cap.
Yeah. So let's start with the market and then maybe talk about DraftKings specifically, right? So, for high growth, unprofitable businesses, they generally want or need access to capital, and interest rates are going up, right? I mean, in the U.S., we had our first Fed hike yesterday. There's expected to be 6, 7, 8 more Fed hikes the next year. And so, it makes cost of capital more expensive, and that's harder. And then, if you're discounting back future cash flows, you have to discount them back at a higher rate. And so, you've seen a broad sell-off of about 30-35% in high growth tech stocks year to date. And so I don't think the sports betting and online gambling industry is that different. When it does come to some of the more sector specific and maybe stock specific issues, like with DraftKings, DraftKings, when they reported fourth quarter earnings, they guided to $825 to $925 million.
Right.
Consensus at the time was around negative 550 to 600. We were actually in the range. I think we were at about 875, 880.
Okay.
But we were the street low. And so the market had to come to the realization that near-term losses are going to be much higher than than the market anticipated. Look, I think that we have a very detailed state-by-state buildup in our model of how states will turn profitable and the curves of gross margins, of operating expenses, of marketing, everything. And so that's what gives us confidence that there is going to be a turn in the next couple of years. But people's short-term expectations were just way too optimistic on profitability.
Right. Fair enough. And I mean, looking at the macro trends here, you mentioned obviously that there are expected interest hikes that will be taking place throughout the year. And traditionally, that, of course, is a negative thing for growth stocks, that interest rates are increasing. So wouldn't you expect that potentially there will be further losses on the stock markets for the online gambling and online sports betting industry in the United States, seeing that they haven't reached profitability yet?
Yeah, I mean, so when we think about the stock market typically discounts what's going to happen, what's expected to happen in the future. It doesn't discount what actually happens, right? So
Right.
if you think about it, like investors, like me saying that they're going to be, potentially be 6 rate hikes this year, investors know that, right? Like I'm not speaking out of turn here. And so that should be discounted in the stock prices today versus every time there's a rate hike, the market freaks out because the market should know that this is is expecting this to happen.
Yeah. All right, fair enough. And so moving on a little bit, we've been focusing a lot on DraftKings here and high multiples. But if we reverse the focus here a little bit and we focus on a tier 2 operator with high ambitions, I'm Swedish, right? And I've been in the online gambling industry for a very long time. And one company that I've been following for a long time is Kindred, which has traditionally been one of the strongest Scandinavian operators here. They have had a quite ambitious target to reach high single-digit market share in the states where they are live in the United States. However, as it turned out, so far they haven't really been able to make a dent in the market where they are active. And speaking about multiples, I think Kindred is trading at like a 6.5 PE ratio at the moment, super low. Obviously, there are some concerns and a lot of headwinds in Europe in their core markets here. But the question is more on the American side here, Thomas. I mean, as it is turning out at the moment in the North American market, it seems very much like the American market is for the big players only. And the likes of Kindred are not able to kind of make a dent in the market. What's your expectation long term here? Do you think are there any possibilities for tier 2 operators to establish themselves in the US, or is this specifically a tier 1 market?
Yeah, so let me first off by saying that I work a lot with our European gaming analyst Ed Young, who knows the European operators a lot better than I do. He covers Flutter, so I was looking up data. But if you ever have questions on Flutter on valuation stuff, ask Ed. Look, so we expect the top 5 operators in the U.S. to get to about 85% market share. That's between Flutter, DraftKings, BetMGM, Caesars, and Penn Barstool. That does leave room for a couple of other operators. I think in Australia, the top 5 operators have about 95% market share. Okay. So it does leave room. I would say a couple of things that are tough, right? First, mover advantage helps, right? So if you look at, there are certain, the beauty of the U.S. market is there are, I think, 31 states that are in operation right now, and over 20 of them give you data. And so you can see there are certain operators that came in late in states and they haven't performed as well versus if they came in on day one. And so I definitely think there is some level of first mover advantage. And if you take the companies at face value, a lot of them have said they've been pleasantly surprised by customer retention that they've seen in the U.S. market. I think that you're also competing with companies that have a lot of capital and are willing to spend that capital. And then 2, as they have omni-channel models, right? And so when you think about the brick and mortar casino operators, for example, they can get more out of a single customer than an online company can, right? Because they can convince them not only to bet on their iPhones or whatever their phones, they can also be like, oh, and come to Vegas or come to a regional casino, and they'll make money off of them there too, right? And for DraftKings and FanDuel, they also have big DFS businesses. They're not as big as their sports betting and online gambling businesses, but they have big DFS businesses and horse racing businesses that they can also monetize people in. And in DFS, a lot of that is a network effect, right? You don't want to be on a DFS platform that has 5 people on it because the prize pools will be smaller. They'll have fewer events that you want to be a part of. And so scale really helps, those companies stay on top there.
All right, fair enough. It makes sense. It's an interesting thought. And again, I guess the dust is settling somewhat now a few years later here. And organizations like Kindred, for example, will obviously have to ask themselves the question if they want to continue with this very expensive venture that is the North American market, of course. But I have another question here as well, Thomas. You mentioned first mover advantage and the retention rates. And, I've looked into the numbers as well and been seeing that DraftKings have been performing really well on their retention rate throughout the years. But another company, if we flip the coin here and look at the New York launch specifically, obviously there was one operator who launched very aggressively into that market, which was Caesars, of course, with their a bit controversial $3,000 deposit bonus, and they were able to accrue a very large market share at the start and at the launch of the New York market. But after the launch on a week-to-week basis, because New York is one of those great states that reports the numbers on a week-to-week basis, right? They have been steadily losing market share, and particularly it's Flutter who have then taken advantage of being able to grow their market share on a week-to-week basis. So can you talk about what's your opinion on Caesars specifically, and this very controversial $3,000 launch that they did with the deposit bonus in New York? Because I would assume that when investors are reading the quarterly report in Q1 22, it's going to be a very bloody story in that quarterly report. What's your expectation?
Yeah, so you had to put Caesars into context, right? So prior to them rebranding the sports betting business from Legacy William Hill to Caesars, they really had mid-single digit market share at best, right? And they hadn't they originally were a JV with William Hill. Neither company were putting a lot of money behind marketing. Neither company were putting a lot of money behind advertising. There was this kind of awkward relationship where William Hill owned the majority of the online sports betting revenue, while Caesars owned, Caesars kind of controlled the online gambling business. And, as you know, there's a lot of cross-sell between those two. And so they rebranded on August 2nd. And then, they needed to go on a marketing campaign, right? And so, they lost about $300 million in the fourth quarter and lost about $500 million. We expect to lose about $500 million in the first quarter. That's a lot of money, but it's very much front end loaded, right? They did, the big commercials. They really got the brand out. You brought up the promo they did. I think they did that promo in Arizona too. And so, a key point that they make, which I think is very justified, is if you had asked anyone 9 months ago, who are the top 5 sportsbook operators in the U.S., Caesars probably wasn't on there. And now you can't question that they are, right? They do have the reputation of not having as good a technology as their peers do. And I think that that's probably part of why they've lost some market share and probably haven't driven as much retention. There was a lot of headlines around bad customer service after they launched in New York. But that's also a function of just the sheer scale of which they got to in those first weeks in New York. And so if you look at the data, I have it in front of me, in terms of handle share, Caesars was in kind of the 40s in the first 3 weeks. and then has dropped down to 18, 19, 20% the past 3 weeks.
Yeah.
Look, that's still mountains in New York. That's still mountains better than Caesars was doing in any market before this. And I don't think that they have the same ambitions in market share that BetMGM, DraftKings, and Flutter do. And so, from our standpoint, Caesars is a name that we're recommending. And part of it is that they can be a player, maybe not the number one player in the industry.
Right. All right, fair enough. And moving on a little bit to the regulatory side of the American market, because when trying to predict what the future opportunities in the North American market will be, we also have to factor in, of course, what states will actually regulate, and not only regulate for online sports betting, but obviously the online casino, the iGaming vertical is the more profitable vertical here, of course. And so far in the United States, only I believe it's only 5 or 6 states that are currently live with online casino as a vertical. And would you say that the fact that more states are considering online sports betting that have not really considered to legalize also the online gambling side, is that a bit of a disappointment so far in the North American market, that there are so many more states that are legal on the online sports betting side than online gambling? And what's your expectations moving forward?
Yeah, so it may be a disappointment for some. It's actually always been part of our thesis and our argument for, and like our arguments for and against stocks, right? So there are 7 states that have online gambling right now. Well, so Nevada is online poker. So a lot of people don't include that, but Nevada is online poker, and so that gets you to 7. We're only forecasting 11 states legalize online gambling by 2025. And look, to your point, I think that history supports our view, right? So last year, Connecticut was the only state that legalized. I believe the year before, only Michigan legalized. And before that, you only really had West Virginia and Pennsylvania in the past few years before that legalized. Because there were the initial 3 states in 2013, 2014, there were Nevada, Delaware, and New Jersey. And so, look, the issue is with online gambling is there's just not as much popular support, right? So every single casino company out there wants to legalize sports betting, right? It's a revenue stream that they weren't accessing before. They want access to it now, and so they all support it. They're then backed up by the leagues and the teams, and they all want it too to increase customer engagement. And so you just have a lot of lobbying support behind sports betting. And there's also just like a, let's say, a public view that, gambling is more of a vice than sports betting. And so, I mean, that is... that obviously I think influences the ability of states to legalize. We expect 42 states to eventually legalize sports betting. We're at 34 right now. A lot of what's happened in sports betting has happened already. But there's obviously really good momentum. And so, we think that over the next couple of years, we'll see, a few more states, or a handful of more states legalized on the sports betting side.
Cool. I mean, zooming in on New York here specifically, it's the New York State Senator Joseph P. Adabo. He is obviously the state senator who championed the bill to legalize sports betting, and we had him on the podcast here the other day. He's going to speak in New York as well during our event in May, and he is now trying to do his best to push through a bill that will actually legalize online gambling as well. He wasn't really that sure that it will happen this year, but he was quite clear saying that he believes that sooner or later we will see online gambling in New York State. What's Morgan Stanley's position on potentially legalizing online gambling in New York State. Is that something you're forecasting?
No. Senator Dabo
Right.
has did a great job of getting online sports betting in the U.S. He was pushing it for a long time, and he got it over. Look, he got it over the hump. I think that online gambling is probably a step too far. I mean, I never want to be held accountable for what's going to happen in the next 10 years, but in the next 3 years, I think it's highly, highly unlikely.
Okay, and that is due to the fact that politically it just doesn't have any support in New York State. Is that true?
And look, I mean, you have a lot of different casino operators in the state of New York. I'm sure not all of them are aligned on how you would legalize or if you would legalize online gambling. And so that's probably part of it. Going back to the earlier side, it's a lot harder to get popular support for online gambling than it is for sports betting. And so I think that's probably another part of it. And I would be very surprised if in the next 3 years it got legalized.
All right, fair enough. Good insight.
For context, I mean, there's been optimism and a lot more momentum in Indiana, Iowa, Illinois over the past few years to legalize iGaming, and not one of them has legalized, and not one of them will likely legalize this year. I mean, Indiana, if you act like any of the main public policy people, what state was most likely to legalize online gambling this year was Indiana, and that bill didn't even pass out of committee, so it's already done.
Yeah, all right, fair enough. I mean, staying with the big four states here, particularly the California, Texas, Florida, and New York. What your expectations on the big four states in the next couple of years? I mean, New York is already live, of course, but it's live with a 51% tax rate. Do we see that coming down? For example, California, there is a movement. Florida as well. Texas, we haven't heard anything. What's your expectations on the big four?
Yeah, so let's go through them. So first of all, on New York, we think, as I said, no iGaming, 51% tax rate. I don't think will come down. There are lots of reasons why it should come down, right? Having that higher tax rate obviously gives an advantage to offshore operators. But, New York is making a lot of money, and it hasn't, as we can see, it hasn't stopped the operators from marketing aggressively and trying to generate a lot of revenue. And so, I think that'll continue. Look, we have to remember that New York is a unique state where operators are going to try and get a stronghold there no matter what the tax rate is, just given the size of it and given the kind of the focus on it. Texas, we used to be more optimistic. We now no longer have it legalizing sports betting, and definitely not online gambling. I never say definitely, but not online, even less of a chance online gambling. It's a more conservative state. The lieutenant governor there has a lot of power within the legislature, and he was very vocally opposed to it. It's also a state that only has a legislative session every 2 years, so it means that it takes even longer for things to happen. Florida, so that market launched for 6-8 weeks, and then has closed down again. We do think that market will resuscitate itself at some point in 2023. We forecast it going, staying in kind of the monopolistic fashion that it was before, and staying with just sports betting. Finally, on California, we forecast California legalizing online sports betting in 20. Sorry, no. We have California legalizing sports betting in 2023, but only retail sports betting, not online sports betting. That will be really
why is that? Why is that, Thomas? That it's only retail.
So the tribes in California have a lot of sway over the political dynamics there. We went to Sacramento in 2014 when there was hope that online poker would legalize. That has never happened. And so that just kind of reinforces us the strength that the tribes have in the kind of political process there. Look, the commercial operators are putting a lot of money behind trying to create an online marketplace. Not saying it can't happen, but the tribes are also putting a lot of money to kind of defeat that too. And so, we maybe are taking the more conservative approach, but that's why we don't model the online market launching there next year.
All right, fair enough. It's interesting. I mean, there are some movements, obviously, to introduce bills in California, but again, a lot of opposition in the state. In other words, interesting to hear on the retail side.
Yeah, look, the other issue with having multiple states that multiple different potential referendum questions is it often confuses readers or potential voters, right? And if they see like 4 questions on the same topic, they're just like, no, and move to the next question.
All right, fair enough. Moving outside of the United States a little bit here, we're going to start running off here in a little bit, Thomas, but I have 2 more questions for you. First of all, there's been DraftKings were considering to potentially put a bid on Entain here a couple of months ago when their market cap was obviously significantly higher and it made more sense. And what would have been positive with an acquisition like that for DraftKings would, of course, be to acquire revenue streams internationally as well in order to potentially grow the company much larger. Now, there's also been talks on potentially American operators looking into the Latin American opportunity, potentially diversifying the revenue streams outside of North America. What's your thoughts on that front? Do you think that the American operators should consider opportunities outside of the North American market as well?
Yeah, I mean, look, I think so Ontario is going to launch on April 4th, and a lot of operators are going to, U.S. operators are going to launch there. I mean, I think that it's something all these companies definitely need to consider. Things that they have to think about, though. One is how competitive is the market going to be? We've heard some people say the Ontario launch is going to be the most competitive launch ever. Two, what are your competitive advantages in those markets, right? So if you're a legacy DFS company in the United States, luckily you likely have some Canadian DFS customers, but do you have Latin American DFS customers? Maybe not, right? Or maybe not as many. And so it's hard. Is your brand as well known in those markets as they are here? So all those are considerations for whether they should launch. But look, bottom line, if you want to be a dominant player globally, the ability to scale and to get the most cash flow possible is obviously important, right? And so that's why I think a lot of these companies look to see if they can find places to generate free cash flow to kind of support their kind of global ambitions.
Fair enough. All right, so Thomas, we're going to start rounding off the podcast here a little bit. I have one final question for you. As we now look forward, and I mean, Thomas, you're obviously at the forefront of the research within the iGaming industry, representing Morgan Stanley, of course. And I would just be really curious to hear, what's Morgan Stanley's position now on the continuation of the iGaming and sports betting industry?
Yeah, so I mean, generally we're bullish on it, right? I mean, we think that the U.S. market is going to see a lot of growth over the next 5 years. It's going to flip to profitability, which is not really reflected in stocks. It's going to be choppy and it's going to be volatile, and we've understood that, and we've been recommending stocks and not recommending stocks and recommending stocks, based off of kind of that timeline. But we definitely have a more positive view. I mean, I know Ed Young, our European analyst, I was with him this past week when he was marketing to U.S. investors. his general commentary around the global business is pretty positive too. He thinks that once there's more clarity around certain regulations, it'll let people better underwrite the future value of these stocks. And the reality is many aren't getting credit for a lot of their growth initiatives. And so net, right now we're pretty bullish this space.
Fair enough. It's a volatile industry, but who doesn't like a little bit of volatility in their life? We are in the gambling industry after all. Thomas, thank you so much for taking your time with us today. And again, I'm really looking forward to meet you in person in New York in May. Thank you so much.
Looking forward to it, Pierre. Thank you very much.